So that's not part of the CRM rollout?
Might help me.
Yeah.
So we'll, you want to open it up 10 minutes before, guys?
7.
Got to be on our best.
We still have to talk.
Yeah, right. 5.
Recording on YouTube, so.
Hey, Kathy, is there there's no Women in Primerica convention this year, right?
No, there's a workshop at the convention, and so the
Okay.
convention is always run the in between year.
Yeah.
Between conventions, yeah.
Okay. That'll be good. And Kurt Puhl is our guest today, is he not?
Yes.
So just waiting for Kurt to roll in.
Scott, are you on Kurt's on his training on Saturdays?
You know, I was on this past Saturday. Yeah.
Yeah, I was there about 3 weeks ago. He's always got good stuff on there.
Very good. Very
Yeah.
good.
Yeah.
No, he knows his stuff. He does a great job of teaching it, and he is committed. So fantastic. It'll be a good day today. Brad, do you just constantly make new background slides?
As I need.
It's like
It's easier to
changing
change
hats
it.
for you, eh?
It's
Each
easier
show
to-
has a different slide.
It's easier to change your background than your shirt.
Hey, Elton doesn't like the competition, Brad.
I know.
Eldon will never be able to keep up with that Brad guy, you know. I'm just not that same league and level, you know.
They're very nice backgrounds, sleek, trendy. Eye-catching. Yeah, they're very nice.
This is actually my room.
Oh, sweet.
Oh,
No, I'm
nice.
just kidding.
Love it or list it, eh?
Yeah.
Are you guys getting a lot of people calling for, hey, I got to get my money into the IRAs, et cetera?
Mark, you look like you should have a mullet to go with that.
That's good.
I don't like the position of that. That's true. It is that. Wow.
I can compete.
You know, next week you could throw on, maybe you could get a mullet or something, you know, just really shake things up a little bit for people.
Show an old picture of yourself from Michigan.
Well, I've got
Yeah,
some.
Were those high school pictures? Man, young ones.
Okay. So we're rolling out coming up 7 minutes before.
Okay.
Let's let people roll in. I'll click the start button, and Brent, you can just spotlight, and away we go.
Sure thing.
All right. Looks like everyone's
All
coming on. Hey, Mike Krasinski, whereabouts you located?
We've got an office in about 20 minutes north of the Twin Cities in Minnesota. And then we have another office. We actually live about 2 hours north of the Twin Cities on a small lake. So when I'm down here, I stay at my mom's, usually Tuesday, Wednesday, sometimes Thursdays, and then drive home. Then I have an office up in God's country.
So you're making 400,000, but still living at home with mom?
Yep, someone's got to do it. Hey, she
That's
cooks
awesome,
and-
man. No, it's a beautiful, beautiful area. I've been there a number of times chasing tornadoes. So
Okay.
I'll stop by next time we catch one. But hey, last couple of years, you've moved your income from 150 to 400. Talk about that. What did you do? What tools did you find most useful, and how'd you make that move?
You know, part of it is I got to give credit to a guy in Pennsylvania. Actually, his name is Rich Griffin, and he has a system we call it the SEAL system. It stands for Securing Every American's Legacy, and basically, it's where you teach. You know, instead of a one step, try to sign someone up. It takes time to educate a consumer, especially when they have money. Older people, they're just usually not going to hand their money over. So you give them the education and find out really what their goals are, their dreams. You know, they want to know you, and you want to get to know them so you can help them with a good process and good product. So that's really where that came from. And just being you, I mean, just being yourself and really getting to know those clientele.
Yeah. So do you think you almost have to pay your dues early on, working smaller clients? And I think everybody would like to come in and all of a sudden grab $1 million clients, right? Can you
That's
talk
right.
about that process, the seasoning you have to go through as a financial professional to earn the right almost to work in those markets?
That's right. So a lot of the people, it's people have talked about on this call many times about, it's a $50, $200 PAC that now that client has built wealth. You've stayed in contact with them. They've trusted and liked you. You built that relationship, and then all of a sudden, something happens in their life. They either retire, have a rollover, they inherit money. Something happens, and they come to you. Versus the industry wants to, only go after the big money. They don't want to deal with the guy or gal that's got $50, and that's our bread and butter to start with. And just like you said, over time, you get older along with your clients, and you build that relationship, and they come back to you, and it's all great.
Yeah, I mean, and you obviously are traveling. You have 2 offices, or
Yes.
Okay, so I find a lot of people in the business right now, when you say, "Hey, I've got a client who lives an hour away and they want to do a $50 PAC." For me, back in the day, I mean, I'd drive anywhere for a $50 PAC. I'm like, well, that's $1 or $2 a month for the rest of my life. That's the way I looked at it. In the beginning, that's what you do, right?
Yep, that's right. I mean, still to this day, I still treat everyone the same. Obviously, you can be more technical if you need to, but really I mean, all those people that have a little bit of money, someday they're going to have a lot of money. And so I have no problem with traveling and seeing people or whatever we got to do to take care of them, because I just know that someday it's gonna reap rewards. And you're building a business for, hopefully our son is looking at our business, and someday he's going to have a business, and he's going to have to go through the same thing. But at least hopefully we can get them so they don't make mistakes like we did. Yeah.
I mean, in Canada here right now, you can't find an advisor who will work with you unless you have at least $250,000 now. And so that our bread and butter, I mean, we're finding more and more clients now. Used to be we'd only deal with the small ones nobody else wanted, but now we have a lot. We're dealing with everybody in the market, and we provide as quality a service as anybody else. But like you said, our bread and butter is still, we'll work with people that nobody else wants. And then when we get them to the level of the 250, of course, everybody's wanting them. But if you provide great service, I think if you're using the CRM and you're communicating with those clients, they're not going anywhere afterwards, right?
No. And that's, we've been pretty good at over the years. And then when Arlie bought our code number, it really meshed, because that's what our philosophy was. But my wife still sends out a birthday card to our clients, even though some of them get electronic. It's fine if they get both. I can't tell you how many clients have said, "Hey, we appreciate the birthday card. You guys are the only one that sent us one." Christmas cards, all that kind of stuff. I just had $100,000 rollover about a month ago, and this lady bought a life insurance policy from me 13 years ago. I've only maybe talked to her once, but when I went to her house, I said, I couldn't even remember who she was, to be honest with you. But when I went and saw her, I remember actually where she lived as I went to the house. And I asked her, I said, why me? And she said, "Mike, you're the only one over these 13 years that have kept in contact with us. You've sent us stuff, and the timing was right for me now to talk to you to roll that over."
Yeah. How many clients do you have altogether?
We send out about 650 cards a year.
So a lot of people look at that and they say, well, how can I possibly continue to go get new clients, do the things I have to do in the business, and talk to your clients all the time? But you made a good point. They're not expecting you to phone call them every day or every week or every month. Just that communication of the birthday card keeps in contact with them. And in most cases, that's all people want, right?
Yeah, exactly. And it's, the industry doesn't do that. And so sometimes people say, well, that's kind of expensive. Well, you know what? Every time I've ever sent out a mailer, I've always made way more than the cost. And you just don't know what's going to happen when those our customers get stuff from you. It could be like this lady years later.
Good
And-
return on investment.
Exactly. Yeah,
Yeah.
for sure. Yeah. Yeah,
Awesome.
it's been great.
Great. Thanks for helping us out today. Eldon, I think we're almost ready to get going, buddy.
It is that time to kick it off again. Another great show. And so just let people know that these aren't being recorded. Please just put your questions and answer, we'll answer your questions. Put it in the Q&A side of things. Chat box is turned off. So anyways, we got a fantastic start here and we'll kick it off. Kathy is going to kick us off today. So if we can just turn it over to Kathy. Kathy, take it away.
Hey guys, how are you? I just wanted to touch on something super quick here. So I'm going to share a slide with you. We had been chatting a bit as a team here about work and work effort and the hours that you have to put into things here. And bottom line is, if you want to be successful at anything, right, you have got to work hard at it. So most people work kind of hard, right? In your jobs and things like that, you can see that they kind of work, average hard. So really successful, you have to work harder, but you also have to be super focused at that. And we don't want to end up with a life where we're successful money-wise at work, but we're not successful in the other parts of our lives. So I don't know any parent that would want to go 24/7, 365, for 5 years, right? You'd miss all that time with your kids and your family. So when I started, I had a 3-year-old and a 1-year-old, and Matt was working and I was working full time. So this whole idea of building a business, I really had to figure out, how to work really hard on this business and still maintain all those other things. So I highly recommend that you get the book First Things First by Stephen Covey. Got a picture right up here for you. If you don't want to read the whole thing, you can go almost to the middle and there's a little exercise about defining what and who are important to you, what your roles and goals are, and how you minimize that to get to the key ones, and then how you work that plan. It's excellent. It's absolutely excellent in terms of doing it. So I'm going to give you a quick example so then we can get to Kurt, because he's awesome. All right. Here's my example on the left. I had these particular roles. So I picked the roles out of the, what I wanted. So I wanted a good relationship, wife, partner with Matt. I wanted to be a great mother. I wanted to make sure that our extended family, we're a big Irish family, and so we got all kinds of cousins and stuff, and that's super important to me. So I wanted to make sure I was maintaining and growing those relationships. And then my other 3 primaries were personal recruiting and being a personal producer, building a base shop, and building a hierarchy. And then I had another one, which was happy clients, and I was thinking about what Mike said. Mike, we were totally exactly the same about philosophy for clients and people, and I realized that I didn't have enough time to do that personally 100%. So I hired a person, and that's why we talk a lot about this on MPI, about getting staff and getting support for that. So you might want to have different PFS goals. You might want to be building more of your personal AUMs or developing business plans, maybe less recruiting or something like that. Whatever it is, you're defining what you want, and then you're taking that, defining what success is in it, and then you're applying that to your schedule. So again, super simple example. I just made sure every single month, every single week that I was putting specific time and important time towards being a good wife, being a good mother, having those relationships and activities, and building the business, and then really work that into the schedule to work it. So I'm not saying that you don't have to put a lot of hours in. I am saying that you want to make sure that you know what your roles are and what you want over the course of your life, and then you devote that time towards it. And there's nothing like that First Things First book to really help you do that. So that's it.
Hey, that's pretty super. That's amazing. Nobody does a better job. Nobody does a better job of working with people, prepping. Let's stop the screen share here. And you know what? You are an inspiration to all of us, Kathy, and we appreciate your hard work. And we always look forward to the way that you work with your team, the systems in place, and rolling things out. And you do a fantastic job of taking new people, getting them up and going. And so anyways, Mr. Kurt Puhl, I know you got a fantastic day lined up for us. And so we're turning the ball over to you. Run with it.
All right. Well, I'm excited to be back with you guys and hopefully provide some form of value to you. I'm really enjoying the MPI personally. I'm learning a lot myself. I'm excited about that. And I think the show brings a ton of value to folks. So today, or one of the things you've probably discovered is I'm not really a motivational dude. I just kind of tell you, hey, here's what I see and here's what I do. It doesn't mean I'm right. It means I think I'm right, but it doesn't mean I'm right. Okay. So I'm going to just walk through a bunch of different things here today. I'm going to kind of shotgun a bunch of stuff at you. So first of all, I showed this slide last month. I'm just going to remind you again that people are worried, people are scared, people are nervous, and you need to be a calm, consistent voice in their ear. When they bring up stuff that they're scared of, you need to be calm and have a little smile on your face, not laugh at them, but like show confidence and comfort. Okay. So ClearBridge did a talk a couple days ago, like 80 or 90 pages of data. I have 3 for you from the talk on the economy. The overall viewpoint they have is we're in expansion, folks. Recession risks are below average. The consumer headwinds are smaller than the tailwinds. It's going to be a bouncy year, but they don't have big concern. And I will tell you, I don't have big concern. Again, doesn't mean I'm right. It means this is what I'm talking to my clients about. It's how I'm handling my wife and I's own personal money and my exterior family's money. A lot of people want to get out of the market and wait and so forth. And I showed slides last month, and here's a different version of that. But here's the decades from the 30s through the 2010s, right? The average return was 114% over a decade. Yet if you missed the 10 best days out of a decade, your average return was 44%. Gigantic difference. In addition to that, if you look, right, if you miss the 10 best days, you lose 70% of your profits. But if you look, 28% of the best days are in the first 2 months of a recovery when a bull starts. And many times people are still on the sidelines scared, and they missed the profit, right? Here's another one about people trying to time the market, get in and get out when I think it's the best, when you think it's the best. This goes back from 36. It shows that if you sold consistently 10 months prior to the peak and bought back in 10 months after the bottom, your return was substantially less. So I've always been a buy and hold person. I teach our clients to be a buy and hold person. But with managed accounts, we're going to spend a little time on that later on today. With managed accounts, you do get some advantage here because you've got people smarter than us making adjustments and making changes and rebalancing and doing things. So we believe in leaving the money in the market, not taking it out on the sidelines and putting it back in. We believe in leaving money in the market and hopefully dollar cost averaging through that. So couple quick thoughts on this, right? Here's a thing that we run into a lot. It was touched on several months ago. I'm going to actually show you an actual client example. Okay. These are clients that just retired or in the process right now that I'm going to show you. I'm actually going to show you a Social Security statement. Obviously, all the names are taken off to protect the innocent, but I'm going to share with you what our viewpoint is on Social Security, right? So here's a client statement, right? This is their statement last fall, and they brought it in to meet with me. And the first thing that we want to notice when we look at this, right, is the Social Security Administration advertises they're broke. They just don't normally tell everybody about it, but they advertise they're broke. Okay, by 2035, they're going to pay 79 cents on a dollar. Don't be shocked if it's sooner than that. We've got Social Security statements going back into the early 2000s, and that used to be 2042, and then 2041, and then 2039, and now they're at 2035. Don't be shocked if it's sooner than that, okay? But let's look. This particular, this happened to be a young lady, right? Born in 1959, okay? Her full retirement age, she would get $1,513 a month if she waited until 66 years and 10 months. If she started early at age 62, she'd get $1,076. Now, the vast majority of the people initially think I need to wait because I'm going to get more money. Well, there's two sides to that coin to analyze. Let's do that, okay? By waiting to full age, 66 years and 10 months, they get $437 per month more, but they would forego $62,408 that they would have received if they'd have started collecting at age 62. So then the question is, how long do I need to live past age 62 to make up what I lost, okay? Simple mathematical formula, 11 years and 9 months, okay? So normally it's around 11, maybe 12 years. That's a normal time frame, okay? So they have to live to be virtually age 79 until they'd have more money by waiting, all right? Well, folks, you and I all know age 79 is not promised to anybody. In addition to that, if they start taking it at 62, this person, that's $1,076 a month less they have to take out of their investments, which means their investments last longer, okay? So also, as we all get older, I know I'm the only person getting older. Kathy still looks like she's 40. It's not fair, Kathy, okay? You know, you're not as active. People want to have more fun before, not after 79 virtually, okay? But there are things you have to pay attention to there. This is a brochure you can download right off the internet, right? Because there are some ramifications if you take it early, if you have earned income, okay? So if you start taking money before your full Social Security age, there's a great chance you're gonna have to pay some back. Right now, the number is $19,560. So if you start taking before full age and make more than $19,560 working, you got to pay part of your Social Security back. Many times in that case, I would go, I wouldn't start early. Why would I want to pay it back to the government? What's the point of me working then, right? So the question is, what counts? Okay, well, earned income is what counts. If you have a pension plan that your company puts in for you, that counts. But income from investments and so forth does not count towards that $19,560. Now, I talk to people about this, but like on this specific situation, I tell them, you talk to the Social Security Administration, you have them tell you. I'm giving you my viewpoint, you have them tell you what the facts are in your particular case, okay? But many times we tell people, pull the trigger at 62. We did that with my own parents, okay? Because they didn't have any earned income, it made full sense. So maybe that'll help you analyze as you're analyzing, should people, shouldn't people, or should they or shouldn't they? You decide that, okay? Now, I'm going to talk to you about using the Morningstar portfolio comparison tool. I really like that tool. And when we're doing mutual funds or doing annuities, this tool is a great piece, okay? So let's spend a few minutes talking about how we use that tool. Now, if your RVP teaches you different, listen to your RVP. I'm teaching you how we use it, okay? So we always we check the cover page in Portfolio Solutions, and we always use the S&P 500 for the benchmarks. Here's why we do that. This will default to custom benchmark. And that means what the client currently has, which will be on the left side of the screen, Morningstar will develop a benchmark to try to mimic what they have. And on the right side will be your recommendation, and Morningstar will develop a benchmark to try to mimic that. But they're not the same benchmark, so the rankings are compared to the customized benchmark, I don't want that. I want to compare to the same thing on both sides. Now I can compare both portfolios to the market. I think that makes more sense because I'm comparing our portfolio to their portfolio and getting a direct correlation. So that's why we always default to S&P 500, okay? 99% of the time, the only tool that you're going to need is a portfolio comparison report. That's it, okay? I think we have to be concerned with giving people, here's War and Peace. I'm going to go through this with you and let you see, 900 pages of data, and the client's eyes are rolled back in their head and they're confused. We need to make it simple and easy, okay? So we think that's all we need to use the vast majority of the time. Now, there's some specific things that we pay attention to other than rate of return, okay? Rate of return we're going to talk about, but it's the last thing that we talk about with the client. We look at other things and analyze first, okay? So we teach the clients about the word beta. I'm sitting here in my office right now, and I've got some of these sheets that I have printed out that I have highlighted like this. So if I'm sitting with the client and they want to see it, I will let them see it versus my explanation to them, okay? So beta is a measure. Now, this is probably elementary for a lot of you, but in case it's not, right? Beta is a measure of risk. When we're using the S&P 500 as the standard, the S&P 500 is a 1, regardless of what it is. It's always 1. So if you have a portfolio that has a beta of 0.9, you're 10% less volatile than the S&P 500. If you have a beta that's 1.05, you're 5% more volatile than the S&P 500. So we need to pay attention to that because a person could have an unbelievable portfolio that's just killing it. But if they're 68 years old and retired, they shouldn't be in something super aggressive with the majority of their money. We may have to teach them that they need to be more conservative to match what their objectives should be. Another thing that we talk to people about is alpha, okay? And if you look at the last line here, it says alpha is often seen as a measure of value added or subtracted by a portfolio manager. Now, if you're thinking these are some funny words, I had a 2.98 in I had a 2.98 in college, which was the best grades of my educational career. Okay, I was a factory worker and a furnace repairman. These are not complicated, okay? If you spend a little time, you can figure them out. I tell people, hey, dummy it down to the furnace guy level so I can understand what you're talking about, okay? So alpha is a measure of value added or subtracted by a portfolio manager. Therefore, our clients would like a higher alpha. There's more value added by the portfolio manager. Last thing that we look at is called Sharpe ratio. And if you look at the last line, it says reward per unit of risk. So we're looking for a high Sharpe ratio because we'd like to get more reward when we compare to the risk that we're taking, okay? So I'm going to show you an interesting story where this comes into play. Several years ago, a really successful person in Primerica, who's a friend of mine, called me and said, I've got a guy that we're recruiting from Edward Jones. If I bring him up to your office, would you spend a few hours with him teaching him why Primerica and why our stuff? And if you'll do that, I'll talk to your team. I said, come on up, come on up, right? So he sat the guy in my office here and we spent a few hours together, and I was teaching him about, our managed accounts we saw, and I was teaching him why we use the funds we use. Now, I'm going to share with you what we use. It doesn't mean that's what you're supposed to use, okay? We use Legg Mason and Franklin as a combination. You'll decide what's best for you. That's what we use, right? So I was sharing with him why I think, that's the best move for us and so forth. He opens up his briefcase. He's got his client list with him. He pulls his own out and he puts it on my desk and he goes, prove it. So I said, okay. He gave me permission. When we got done, he goes, if I was you, I'd use this. I go, thank you. Okay. So this is actually what he had and what we recommended. Okay. So let's look. Okay. We pay attention on the top to the asset mix. Now, the first thing that I would see is there's 26% international exposure. We believe in domestic investing, not international investing. We talked about it briefly before. I'll mention it briefly again. I do a study every year using the S&P 500, the S&P Mid-Cap 400, and the Russell 2000, and the Barclays Aggregate Bond Index. And we compare that to the MSCI EAFE, the International Index, Stock Index. And as of 12/31/21, looking backwards, the last 1, 3, 5, 10, 15, 20, 25, and 30 years, the international index has lagged all three U.S. stock indexes in every single time frame, and is sometimes beat by the Barclays Aggregate Bond Index. So when I'm talking to people, and obviously I'm here in the States, right? So Brad, this is maybe different for you guys, but for me, I'm here in the States, right? If I'm talking to people, I share that with them and I say, so I don't see, so my opinion is, why would I invest in international exposure to earn a lower rate of return on my money? I'm going to take 2 additional risks, currency exchange and less stable governments, to earn a lower return. To me, it doesn't make sense. I'd rather keep my bet in the good old USA, not China and Venezuela. Wouldn't you agree? And I mean, I'm telling you, the vast majority of the time, the response is like, yeah. That's the response that clients give you. Okay. So that's the first thing I would see is I don't like the international exposure. It's not a bad allocated portfolio. Otherwise, let's break it down. Okay. So we look at the tic-tac-toe chart, for lack of terminology. We look at the tic-tac-toe chart, and he did not design a bad strategy. Okay. Ours is a little different. He didn't design it bad. Now, here's where we're going to start looking at the statistics. All right. So we start out looking at beta. Okay. I'm sorry, I'm looking at the side. I got a bigger screen right here that I'm sharing with you guys. I'm looking at. So we looked at the beta. Okay. The 3-year beta on his portfolio is 0.86. Our 3-year was 0.85. Our recommendations on the right, theirs is on the left, what he owns. The 5-year beta is 0.86. Our 5-year is 0.85. And the 10-year is 0.87, and ours is 0.85. So we're actually, he did a fine job from my viewpoint of what his risk should be. Okay. Now let's dig deeper. Let's look at the alpha. Remember, alpha is manager add or manager subtract value to the portfolio. His 3-year alpha is negative 3.83. Ours is negative 0.69. His 5-year is negative 2.71. Our 5-year is positive 1.3. And his 10-year is negative 2.29. Ours is positive 0.4. So if you look at value added by the manager, it looks like our recommendation is going to be better. Okay. Then we looked at Sharpe ratio, reward per unit of risk. His 3-year is 0.8. Our 3-year is 1. His 5-year is 0.77. Our 5-year is 1.06. And his 10-year is 0.87. And our 10-year is 1.09. So we've got about the same beta. We have better alpha, value added by the manager, and we have better Sharpe ratio, more reward per unit of risk. Now let's look at the returns. Okay. Their 1-year return is 3.35. Ours is 3.25. They're beating us by 0.1% in the last year. I'm sorry, that was 1 year, excuse me. Their 3-year is 12.07. Our 3-year is 15.38. Their 5-year is 10.87. Our 5-year is 15.1. And their 10-year is 10.2, and our 10-year is 12.9. Now, I have all these pre-built in our software. So what happened, he gave that to me, and I entered his stuff in and just chose his portfolio and put it up on the screen and showed it to him. I will not use the words he used, okay? But he said, I'll be It took me 6 weeks to design that, and it took you 1 minute to beat the out of it. I can't believe it. Okay. The tools we have at Primerica are great. And the products we have at Primerica are great. We just need to learn how to use them. Okay. So the funds he used 6 different fund families. He was trying to mimic a managed account. If you look at, because it was it wasn't a managed account, it was a retail, but he used multiple different families. Okay. And we used ours. So it was like, boom. Okay. Now, I will share with you one of the big panic things for me when I started was, what if I pick the wrong funds? What if I put them in the wrong stuff? You know, what if I screw something up like that and the people lose money? Okay. So years ago, we started doing something like this in the early to mid 90s for our reps. So we build a matrix like this. So we've been doing this for, over 25 years, developing a matrix for our reps to use. And this is our latest recommendation. So what happens is this: a brand new rep can do the same thing that I would do. Doesn't mean I think I'm smart. It doesn't mean I think I'm right all the time. It means based to the best of my ability, I think this is the best recommendation. This is what I use. And what it did is it gives our reps a ton of confidence, because they can now make a recommendation versus going, oh my gosh, I'm not as smart as Eldon Larson. I don't know which one I would use. Well, we don't have to deal with that. Our reps use this. Okay. So that's just a little bit that we teach our reps about how to use portfolio solutions. In my opinion, we should not sell on performance alone. Performance is part of the solution, but performance isn't the solution. Okay. I bet you go places that give you the best customer service and take care of you the best. They may charge more than other places, right? If your car dealership gives you great service, they make it easy for you. I used to go to a specific dealership and to get my car serviced, and I would go there, drop my car. If they would drive me to my office, let me out at the front door, take my car back and service it, drive it back, putting in my parking place, and bring the keys to my office and give them to me. I'm like, I like that. That's easy. I like that. Okay. So they weren't the cheapest place in town, but I loved their service and how they took care of me. Okay. So price is an issue in the absence of value. Okay. Return, I don't care who you use, you're not going to win every time. It's impossible. But if you teach concept, which again, I mentioned before, Ken Durham taught me, you sell investments on concept, not on return. So I learned that years ago, and we continue to do that today. Okay, let's go someplace else for a minute. Tax laws changed a few years ago with non-spouse inherited IRAs. And I happen to be dealing with some right now. So I'm going to actually show you kind of what we're doing, okay? It used to be that you could do something called a stretch beneficiary IRA, where if you were not the spouse and you inherited it, you could stretch out over your entire lifetime. Well, that changed with the Secure Act. Now, non-spouse beneficiaries have to get the money out of the IRA 10 years after the death of the person. This is an article from Forbes, and you can do your own research to make sure you got it all figured out, okay? So that changed the rules dramatically on what do people do now, okay? Because you got to take the money out. So this happens to be a scenario I'm working with right now, okay? The dad died 3 years ago. Mom died in December of 2021. Okay, so there's 2 children, a 44-year-old son who's married with 3 kids, has a mortgage, and a 37-year-old daughter who's single, buying her first house right now as we speak. They each have inherited a $190,000 IRA. The parents are going to sell, or they're going to sell the parents' house and net a minimum of 80 grand each. Okay, so let me give you a preface. I'm not telling you this is the perfect advice for each of these people. This is what we're doing. Every case is different. I'm just going to walk you through how did we analyze that? What did we come up with? I met with the son on Monday. I talked with the daughter this morning, okay, and things are happening. This is virtually what we're doing. This could change over time, but virtually what they're doing. But first thing for us to think about, right, as a group. Okay, mom died in December of 2021 with the new Secure Act. When does she have to have the money out? Well, 10 years after mom's death. So by the end of 2031, all the money's got to be out of the account. All right. So here's what we did. Okay. We tried to amortize. Okay, how long is this? Let's do this before I go there. We tried to amortize how long would this money last. We have to have it out within 10 years. It's going to be a taxable event because it's all pre-tax money. So what do? Do we take all 190 out at one time? They're going to get killed by Uncle Sam. What do we do? Neither of. So what we're doing is I'm trying to estimate how much do I have to take out per year to have it exhausted within 10 years. That seems to make the most sense for each of these scenarios. Okay. So here's what we did: 190,000. If we amortize and get a 9% return, we got to take about $23.89 a month out to have it gone in 10 years. That's a starting process. So what we're going to do, in this case, we're going to take $1,000 a month and fill each of their Roth IRAs. The spouse has a 401k at work that she's putting up to the match in about $475 a month. We're actually going to go increase that to the max for her. She could do $20,500. So she'll max out that. That will increase her tax refund, their tax refund, by $4,143 a month by putting more money in their 401k. They do not have a Roth option. Okay. We're going to adjust their W-4 form to put $250 or $3,000 a year of that $4,100 that we're creating back into their budget so they can work with that every month, because we all know big tax refunds are poor planning. Now, they currently get an $8,400 tax refund. They got a whole passel of kids. That's going to kind of eat up the $28,000 or so that they're going to take out of the IRA. That's going to cause a taxable event. Their current refunds are going to kind of wash that out. So we're going to put $406 a month in their emergency funds, right? The money from adjusting a W-4 form, and the $156 that's left out of the monthly amount they're taking out after Roth and 401k. We're going to take the $80,000, put it in an emergency fund and short-term fund. We may prepay the house. We're going to kind of let things settle a little bit. The goal is, after 10 years, when all the money's out of mom's IRA, their short-term and their emergency fund will leave them enough cash to continue filling their Roth IRA until they want to retire. We did the F&A, the FIN number. This puts them in fantastic shape. Again, I'm not telling you this is all the perfect strategy. This seemed to make sense. I've met with the son a couple different times. This seems like it made sense. For the daughter, different scenario, okay? She's actually in the process. She's closing at the end of this month on her first home, okay? Now, she was going to have PMI. My thought is, well, if you got to take out $28,000, $29,000 a year anyway, if we're going to try to spread the tax burden out over time, we just took $32,000 out in a lump so she can put that down on the house and avoid PMI. Okay, which seemed to make sense. We won't take any more money out of it this year. We're going to fill a Roth IRA with the $80,000 from the sale of the house, so she can fill that. The $74,000 we'll put in an emergency fund and a short-term fund for now. She has no retirement plan at work. Next year, we're going to start out of the $23.89 we're going to take out every month. We're going to fill her emergency fund, or fill her Roth IRA at $500 a month, and then we're going to put the rest in the emergency fund and short-term fund. I want her to buy, pay cash for everything, right? Our goal is to get our clients where the only debt you have is your house. Everything else is paid for, okay? We may start prepaying the house. We have to see how that happens. She's getting a $4,500 tax refund. She may owe a little bit. We may adjust a hair there. We'll see how that goes. But the same concept when we're done is, after 10 years, we've built up cash in the emergency fund and the short-term fund. so she can fill her Roth IRA if her budget doesn't allow it. In the meantime, if a transmission blows up in a car or something, she has cash to cover that. Okay. Both of these strategies know what a pocket cost to the client, but helping them figure out what makes the most sense for them. Now, here's an interesting thing about non-spouse IRAs. Now with the new tax law change a couple years ago, it causes a taxable event for the kids. That's another reason that we should be teaching clients about doing Roth conversions. Okay, because the Roth being tax-free on the way out, if that 190 each would have received would have been in Roths, hallelujah, fantastic. Okay, so we have been teaching clients for years, and especially in down markets, that's the time to do Roth conversions. Here's why. Let's say you were going to convert 10 grand, just as a number for a discussion. Well, when the market's higher and the share price is higher, you convert, it takes less shares to make the 10 grand you want to convert. When the market's lower, you actually convert more shares to get that 10 grand. So when the market recovers, the client never paid taxes on all that money. Okay. So down markets are a great time to do Roth conversions. In addition, because of the tax law change for non-spouse IRAs, Roth conversions are super, super great. Okay, let's switch gears and spend a few minutes talking about managed accounts. All right. Now, the following slide will not be a perfect example of mutual funds, ETFs, and SMAs, but it's what I use when I talk to clients. Okay. Again, I'm a furnace guy. I don't want to get so complicated that I'm blowing the client out of the water with so much information. Okay. So we have three options in our managed account portfolio: mutual funds, ETFs, and SMAs. Okay. Well, what are they? Right. A mutual fund is a portfolio. You buy shares of the fund, and the fund buys the stocks or bonds. An advantage of a mutual fund is you're important regardless of the account size, right? If Scott Fletcher is going to put 5 million in an account and I'm going to put 5,000 in the account, I get the same return Scott gets in the mutual fund. I'm just as important as Scott is. He probably got a better pricing structure going in, but all the returns are the same. I like that. That's great. A disadvantage of a mutual fund in a non-tax in a non-qualified account, they're not real tax friendly sometimes. They may have bought a stock years ago and you get in today and they sell that stock next year and you're paying part of the capital gains from years ago because they've held the stock long term. Second of all, other shareholders' poor decisions can affect you. Again, we'll use Scott. Let's say Scott, Mike, and I are all in the same mutual fund, right? And if I'm foolish and March 2020 happens and the market's going down the toilet, Scott and Mike go, cool, I'm just going to hang on there. I'm going to hang in. It's no big deal. But Kurt, being emotional and scared, sells. Well, if a whole bunch of people do that, by law, the mutual fund has to redeem shares within 7 business days. Okay. So what happens is they're forced to sell stocks at a loss to get cash to give the clients like me that panicked and took their money out. Well, that affects Mike and Scott, but they didn't do anything. But other shareholders making poor decisions did something. So advantage, disadvantage. I'm not saying mutual funds are bad. Mutual funds are great. I'm just giving you a comparison of the three options, right? Then you have ETFs, or electronically traded funds, okay? Advantages, they have lower fees typically than mutual funds. They trade live like a stock, where a mutual fund trades at end of day value. A disadvantage is it's usually an index or a sector. It's usually not managed, okay? So lower fees, but you're kind of getting whatever the index gets, okay? And then third choice is an SMA, a separately managed account. In my opinion, these are the king. These are what people want if they could have all of them, right? You buy stocks directly versus buying shares of the fund. So when you buy stocks directly, it's tax friendlier. Let's go back to the example in the mutual fund. When you buy the fund today, they maybe bought a stock years ago If they sell the stock next year, even though you bought it today, you may pay taxes on the gain from a long time ago, plus your gain. In a separately managed account, they buy the stocks directly for you. So you buy it today. If they sell that stock next year, you're only responsible for the gain from the time you owned it until next year. They're tax friendlier, okay? Other shareholders' board decisions don't affect you. We'll go back to Scott, Mike, and I. If we all have, let's say, the ClearBridge Dividend Strategy SMA versus the ClearBridge Dividend Strategy Mutual Fund per se, right? If Scott, Mike, and I all own that, and if I panic in March of 2020 and sell mine, it is zero impact on Scott and Mike because they own their own SMA. They own the stocks directly. Whatever I do has no effect, okay? It like a mutual fund does. Disadvantages are of an SMA. It normally takes more money to open one. It's pretty cool. AGF has an SMA, the small mid for 25,000 with us. And then most of the other SMAs are 50,000 in the lifetime portfolio. That's pretty awesome. Okay. So that's a general overlap or overlay of the three choices available. Okay. So let's talk about the lifetime investment platform and some of the attributes that the lifetime investment platform offers us. Okay. So we're going to spend a little time on each of these, just talking about them and what they mean. All right. So number one, ongoing monitoring of funds. Okay. And what I mean is a proactive approach versus a reactive approach. Okay. Here's what that means. Let's say that Brent is a client of mine, right? And if Brent, he has his portfolio with us, and if I decide that I want to change Fund A to Fund B, I have Susan pull up and she goes, Kurt, we have 600 clients that own that fund. Okay. So that means Susan is going to make 600 phone calls, try to schedule 600 appointments for me to talk to adjust Fund A to Fund B. Okay, if I think it's a good idea to do that right now, by the time I get to 600 people, it's months/years from now, by the time you can get all that stuff done. With the managed account, if they go, I want to change Fund A to Fund B, it's done today. It's no questions asked. So if it's supposed to be done today, it's done today, not when you get around to doing it, okay? Folks, clients like it. It's a superior service to you and I trying to make phone calls and do stuff, right? Second attribute that our lifetime has, right, is asset allocation. We can buy multiple sectors of the economy and we can put together an all-star team. And unlike professional all-star teams that are all about them when they don't play as a team, we have stuff that's designed to work together. So I can pick the best one that does large cap and the best one that does bonds, and we can build a portfolio if we choose to. Or if you buy the pre-allocated ones that are built by the different companies, they've taken that into account. An all-star team that actually plays together, right? Next is diversification, right? We don't want to have a whole bunch of stuff that buys the same stocks. So we want to make sure that we're diversifying and having different allocations in different sections. Or if there's a couple large cap managers, they aren't all buying the same stocks. And when you have multiple families to choose from, that's easier than if it's within one family. Third option is called portfolio rebalancing. We talked in detail about that last month. Portfolio rebalancing, we want to keep the client's mix approximately where we want it to be. Here's what we know, okay? And if I'm actually meeting with people, okay, like if I was meeting with Scott, right? And Scott came to see me and he was currently a retail client and I was going to talk to him about managed accounts. I would have his portfolio on my desk and some highlights of the stocks I'm going to move. And maybe I had Scott in 5 funds with 20% in each of the 5 funds when we established this. Well, today, when you look at the portfolio years later, you understand it's not like that anymore because the stocks historically go faster than the bonds. Some years they're different, but we know stocks will outperform bonds long term. So maybe I had Scott in 3 stock funds and 2 bond funds. I had a 60-40 mix. It's not 60-40 anymore because the stocks have grown faster than the bonds. Scott's maybe got 75-25 now. So the portfolio I set up years ago with a 60-40 mix has got more aggressive over time, not because Scott's changed anything, because stocks have performed better than bonds over time. So the older Scott got, the more aggressive he got. Bad plan. Okay. So with the managed accounts with lifetime investment platform, depending upon how you build it or how you use it, they have multiple rebalancing options. So we're going to keep Scott at 60-40, regardless of what the economy is doing, or right at it. So we don't want his risk, because folks, if Scott wanted to be a 60-40 mix, and he's a 75-25 right now, and we have a big downturn in the market, the pain is much worse going down on a 75 stock 25 bond model than a 60 stock 40 bond model. So if we don't do that, we're doing a disservice to our clients. We got to keep them balanced where we want them. Okay. Next, downside monitoring, right? There are no guarantees with a lifetime investment platform, but there is a downside monitoring. They're paying attention to that. They're moving and adjusting and rebalancing and changing. And you can pick portfolios that are less aggressive, where there's going to be more downside. I can't say, well, legally not protection, but less downside than a retail portfolio, right? Next, peace of mind that your accounts managed daily, right? If I'm talking to Eldon, I meet with Eldon once a year and I look over his portfolio. In the lifetime platform, they're looking at Eldon's account every day and making carburetor adjustments accordingly. So that makes him feel better. Somebody's watching his money all the time versus once a year. With the compensation program and find it in line with the investment program, here's how I talk to him, right? Eldon, how the plan works. I'm just going to give you a generic overview. Let's say the total program expense is going to be 1.92% for Eldon's portfolio. Okay. I say, Eldon, listen, here's how it works. Your annual total program fee is going to be about 1.92%. So here's what's going to happen. At the end of every month, they're going to look at the average daily balance of the prior month. And whatever that number is, they're going to assess a 0.16% fee. And 0.16% 12 times is 1.92 your annual expenditure. So here's what happens. If your account balance goes up, you have more money, I make more money, and our company makes more money. If your account balance goes down, you have less money, I make less money, and our company makes less money. So we're not telling you it can't go down, because it's going to go down sometimes. But there's a vested interest for myself and our company to do the best job we can for you, because you want to have more money and we'd like to make more money if possible. So that's how I share that with them, how it works, right? And then accountability and transparency. There are 2 different types of statements people get. One is a monthly account balance statement, shows the beginning and end of the month and whatever happened during the month. And one, right, is a trade confirmation statement. Every time they do anything, they're going to send you something right away. So anything that happens, the client knows about immediately. These are the attributes or the positives of the lifetime investment platform. A couple additional advantages that it has, right? Number one, it's great for representative retention. I'm going to show an example in a minute, okay? So when our reps are profitable, they stay. When our representatives don't make money, a lot of them eventually leave, okay? Number two, it's great for referrals, okay? We have existing clients that refer us to people a lot. We've had a pretty great track record there for a lot of years. But when we started using managed accounts, our referral business went up. And we uncovered other cash that they hadn't told us about because they like the lifetime platform, and it provides confidence to our reps because they maybe aren't like totally comfortable with making recommendations. Now professionals watching your portfolio all the time. Okay, let's talk about representative retention. These are our top 6 part-timers in our office here in La Crosse. This is their recurring income last year only from managed accounts, okay? These are the top 6. All right. Tell me, when are any of these people leaving Primerica? That would be never, because they're making money, their clients are happy, and over time, their income only goes up if they just keep the clients happy, let alone new business, right? If a portfolio averages a 7% annual rate of return, it's going to double every 10 years, according to the rule of 72. Well, if the size of their client, if the size of the portfolio doubles, the rep's compensation doubles, folks. Okay. So I'm going to start to bring this down to a close. I want to share something with you. We've been excited about mutual funds for a long time. Ken Durham got us jacked up a long time ago. Okay. And I don't think a lot of us have an understanding of how huge what's happening right before our eyes is, and some of us are missing it. So let's go back to 1999. Boston College did a study that showed there was going to be a wealth transfer over the next 55 years of $41 to $123 trillion, they said. This is 1999, okay? Then we watched 2000 to 2002 happen, where the economy got killed, and they did an update in 2003 saying, hey, that's real, that's still valid, that transfer is gonna happen, okay? Then we saw a few years ago, right, Primerica put a slide out from CNBC saying there's going to be a $68 trillion transfer happening over the next 25 years. Well, I mean, how do you put your arms around that? Well, I'm a little technical sometimes, so I'm like, okay, I had a calculator out. Check this out, right? $68 trillion over 25 years is $2.7 trillion a year. Is $226 billion a month, is $52 billion a week, is $7.4 billion a day that changes hands on average. A day, okay? Well, how do we quantify what that means? Here's an article from CNBC, right, on defining a trillion. You take $1 bills, stack them on top of each other. $1 trillion in $1 bills goes around the Earth's equator 2 3/4 times, folks. That's 1 trillion. That's 1 trillion. Okay. Then I made up one. Okay. I'm trying to go, how do you grasp this? $1 trillion, right? A commercial airliner flies at about 35,000 feet, right? That's about 6.63 miles. So if it's 67,000 miles, the stack of dollar bills, there's 10,236 stacks of $1 bills between the airplane and the ground. That's $1 trillion. Imagine that you're in an airplane, you look out the window all the way down to the ground. There's 10,236 stacks of $1 bills. That's $1 trillion. There's 68 of those happening, okay? Try to imagine this. There's 696,000. I get excited because I think, like, do you realize what the future looks like? It's like gargantuan, the future. This is from NASA. Okay, from their NASA's website. All right, 1 trillion seconds is 31,546 years. There's 68 of those, folks. This is gargantuan. Let's back up to when the managed account business first started. Okay, this is May of 2012. The company put a poster out trying to sell people on how big managed accounts would be. Our name was on there somehow. We had 13.9 million at that point, which provided $112,000 of passive income. But look at the 10-year total. That was $1.5 million on that chunk of business that we'd paid over 10 years. Okay. January 15, they updated the poster and put it out again. Our name somehow was on it a second time. We had 31 million AUM at that point, personal, which is 240,000, which is $8 million over 20 years. If you just keep the clients happy, that's 42 months in. There are people that are doing it tons faster than that today, killing it. Okay. Let's fast forward. Omar had contacted me in 2001 to ask me some questions, and I said, I'll pull it up. I don't know, right? So 10 years into managed accounts, right? Our managed account recurring income was $455,000 10 years in. Again, there's people tons faster the day. Our latest one, 8 months later, our current recurring income for managed accounts is $520,000. Our recurring income in managed accounts alone has went up by $65,000 in the last 8 months. Now, there's tons better examples than Kurt and Meg. I'm just saying, hey, this is little old us in La Crosse, Wisconsin. There's 50,000 people in the whole city that my office is in. There's 100,000 in the whole county. Okay. So I want you to think about this. How big could the future be when Primerica has been in managed accounts for 20 years, 30 years, 40 years? Unbelievable, the potential. All of us dream of having a ring like this and being in the book and thinking about, man, what would it be like, right? The biggest wall you've got to overcome is your mind. All right. I don't think I'm good enough. I could never be as smart as Brad. You know, I mean, those guys are so smart. It's too hard. I can't figure it out. You can figure it out. Thumb through that book and look at all the people in there. There are like really normal people in there that are making lots of money today. All of us have a goal of the fear of decreasing effort and sacrifice. You work hard for a lot of years, and as you get older or been here longer, you can work less and your cash flow keeps on going and going and going, okay? And there's a lot of people in MPI that have an amazing business, and it's only going to get better over time. So how do I learn how to do all this stuff? Okay, well, MPI is a great place. Plug into MPI every week, right? Plug into the Up to the Minute with PFSI. They have great trainings there, right? There are monthly securities trainings you can get involved in or find people to help you learn, right? Investment company calls, Market Watch, Morningstar. But maybe the best one is you do more appointments. See the people, okay? You aren't going to learn you'll learn a lot, okay? But the best learning is hands-on. If you look at the people talking in MPI, many of them got punched into those tons of times early in their career trying to figure out what was going on. The great thing about learning that way is you don't make that mistake again because it hurts, okay? So to get really good at this business, right? I love Hebrews 12:11, right? No discipline seems pleasant at the time, but painful. Later on, however, it produces a harvest of righteousness and peace for those that have been trained by it. I'm back to you guys.
Hey, thanks. Let's go right to our group of panelists here.
All right, cool. Kirk, great job, buddy. Great job as usual. Couple questions. Portfolio solutions, can people use them to analyze managed accounts?
No, they cannot.
Okay, perfect. We had a few questions on the Roth conversion, and can you give a little guidance on how to determine how much somebody should do in a given year?
Okay, here's what we did. And again, every personal situation could be different. Here's what we did. In each of those two cases I showed you, right? Neither of them had to have a lot of money right now. Okay, well, the daughter needed to buy a house, but it was about what she needed to take out every year anyway. So we're trying to minimize the taxes, right? So we don't drive them to another tax bracket. So we just looked at, okay, if we got to have it out over 10 years, let's amortize over 10 years. And that was a $23.89 a month or whatever it was, getting a 9% rate of return. I told them both, we could get better, we could get worse. We're trying to give you an estimate. So we decided to spread it over the 10 years, made the most sense for the clients in this case. There could be something unique, or maybe if you have a person that's in a lower tax rate right now, you know, maybe if you have clients that are a 12% federal tax rate right now, you might want to take out more right now and maximize that. Each of these two are currently in a 22% federal tax bracket, and they won't go down to 12. So I don't want them to go to 24. I'm trying to keep them in that same tax rate and get as much out as I can without them paying more taxes over time.
Okay, great. Awesome. Can you give some opinions on the tactical side, since you talked about, you know, the best 10-day slides that you missed? What you feeling on tactical?
Okay, this is my opinion. It doesn't mean it's right. I'm not a tactical believer. Okay, there's people that are really successful and do tactical, I think whatever your belief level is, you need to be committed to that belief. And there's something significantly that changes it. I've always been a buy and hold. I don't personally do tactical for some of the charts I've shown last month and today.
Yep, I figured that. The Leg Franklin matrix, would you post it?
Yes, it already is actually, but it could be
thought it was
reposted.
too. Yeah.
Yeah, it could be
And,
reposted.
Can you just talk for a minute about, how you determine the recommendations in that matrix, like what you're looking at to determine it?
Okay, what I look at is alpha. I look at beta, alpha, Sharpe ratio, diversification, and then performance. Okay, so what I do is I pick what, in my opinion, are the best funds that they have to offer. I use those, then I build around them with funds that I think are good funds. But I try to use the players, okay, but I use those parameters. We could build them and have better performance. But if we're too concentrated in one sector of the economy, if that economy goes away, the portfolio is terrible. And in my opinion, you don't lose people if you lag by a couple of points. You lose people at negative 35. So I want to pay more attention to allocation, Sharpe ratio, alpha, beta, and want to get a good number. I want to make money in the good years, not give it all back in the bad years. That's kind of my goal.
Yeah, agreed, buddy. Hey, Brad, you want to jump in on anything?
Yeah, it's somebody was talking about, do you ever get a CPA in? Are you ever advising the client to go to their accountant when it comes to, tax strategies?
I have. I never had a CPA come into our office and speak to clients, right? But if I'm giving anything that's questionable, and if I'm not like absolutely 100% or it's a unique tax law, I tell them to talk to their tax person to confirm my thought process before we make a decision.
Yeah, a lot of questions about, do we sell this in Canada? Well, the tax laws are different. I do agree 100% when it comes to foreign investing, except unless you live in Canada. We believe most of a portfolio needs to be in the US market, not the Canadian market. It's a very small market in the world. And so don't follow that domestic principle if you live in Canada. You'll be denying your client best returns. And then also, we don't have an actual managed account portfolio like they do with managed accounts in the US. Our new PD model is going to be very similar. So there is a few changes, but what you went through this morning, just the like you said, the tactical part of your training and stuff is so valuable on both sides.
We're good.
Awesome. Maybe Brad, you can just close us out with just letting us know who's going to be on this next week.
Yeah, we have a amazing leader coming on, Canadian coming on. Sue Sears has gone up 3 diamonds, just in a rapid pace, 3 diamond movement, and is an amazing advisor, producer, builder in the business. And so she's going to be joining us next week.
Hey, that is super. Fantastic show, guys. We'll wrap it up and see everybody again here this next